Okay, let's go ahead and get this up and going. I'm not feeling well. I am just like everybody else, probably getting this crazy cold and not a happy camper. So, if anybody has it, rest up, get plenty of vitamins, and do your best to overcome this. So, chapter 9, we're going to be talking about advanced topics for state and local governments. And we're going to describe the characteristics of special purpose entities and identify the very required financial statements of various types of entities. Understand the purpose of special assessment taxes and identify the appropriate funds for the recording and reporting of special assessment activities. Apply accounting principles for lease transactions. Employer reporting principles for pension and other post-employment benefits. So, special purpose. Okay, general purpose includes the states, counties, cities, housing, villages. Special purpose entities include fire protection districts, park districts, public colleges, and public authorities. A special purpose entity may be a component unit of a general purpose government. If the entity is engaged in governmental and business type activities, use GASB 34. If the entity is engaged in multiple governmental activities, use general GASB 34. Just omit the enterprise fund statements which are not applicable. Again, report both fund bases and government-wide financial statements. And I remember I was working for Cocopah Indian Housing, and I remember when the ruling came down, that's my soda, that we had to move from FASB 117 to GASB 34. And trying to figure out those, financial reports was a task in itself. So imagine, having very little governmental accounting knowledge, pretty much none at all, and having to move to that. It was quite interesting. Okay, if the entity is engaged in a single governmental activity, the entity can prepare governmental fund-wise statements and reconciliation effects all in one combined statement. If the entity is engaged only in business type activities, you can prepare enterprise fund state financial statements. You don't need a government-wide. If the entity is engaged only in fiduciary type activities, they can prepare just the fiduciary fund financial statements. So this one here, what we're looking at is combined balance sheet statement and net position. So you can see the total governmental funds. I love how they have the adjustments right here. I really do. That makes it easier to read and understand. Special purpose entity adjustments for the government-wide column include eliminating interfund balances, recording capital assets, recording long-term debt, eliminate expenditures for capital items and debt principal, recording depreciation expense, accruals including the interest. Special assessment districts. So they're similar to property tax assessments, but are limited to taxpayers receiving direct benefits. So citizens in a limited area may vote or petition government to provide service or capital projects, and the government may then assess taxes for these benefits. Pay attention to your elections, because I know school district number 1 is getting ready to request a bond for capital expenditures. Service type: downtown merchants want enhanced police protection and are willing to pay through extra assessments. And then residents want their street paved and are willing to have the cost charged to them over a period of time. Government will use whatever fund they normally use for that service to record the special assessment tax revenue. If the assessment is for extra policing and police costs are in the general fund, then the assessments will be treated in the general fund. The accounting treatment depends on the extent to which the government is liable for the debt. The government is primarily or secondary liable to pay off the special assessments construction loan in the event that the taxpayer revenues are insufficient. The government is not liable either legally or by choice, even in the event that the taxpayer payments are insufficient to pay the debt. Construction special assessment issues. Government liable on debt, record construction and capital project fund as usual, record the repayment of the debt, report the assets constructed in the special assessment debt and the government-wide statement of net position. The effect is to treat the debt and related project as if it were undertaken by the government. Government is not liable on debt. No debt is reported in the government-wide statement of net position. Collections of special assessment taxes from the taxpayers and remittance to debt holders are handled in a custodial fund. Lease accounting. Lease accounting is a pain in the booty. And normally that's a more advanced, either in an intermediate accounting course or in an advanced accounting course, because of all the FASB rules and regulations, the pronouncements when it comes to lease accounting. And this has been going on for a while. There are certain criteria that have to be met in order to treat your lease as a capital expenditure or treat it as an operating expense. And so you've got to be very, very familiar with those in order to make sure that you're recording that lease correctly. Short-term leases, any lease contract that has a maximum possible term of 12 months or less. Contracts that transfer ownership. See, these are the ones that kind of get really iffy. This is a lease contract that transfers ownership of the leased asset to the leasee at the end of the lease contract. You treat them like a purchase, a capital asset purchase with some type of mortgage loan, as part of the debt. Other leases, this is any lease contract that does not necessarily transfer ownership and has a lease term longer than 12 months. Short-term leases called operating leases. Let's say that the government needs to go and do some special project, maybe dig a huge hole. I don't know. We're just going to say dig a huge hole in the ground. It doesn't necessarily have that equipment on hand, so they have to lease it, let's say, from one of our tractor or equipment companies, ag companies here in Yuma. And they go in and they lease that equipment because they don't need to buy that equipment because they're only going to use it once in a while. And this happens to be the once in a while. And so they lease it for however much time they need to complete the project, and then they return the equipment. Those are expenditures. Capital leases exceed 12 months. It results in the reporting of an intangible or capital asset and the liability on statements reporting under the accrual basis of accounting. GASB requires lease obligation be reported at the present value of the payments using the interest rate implied in the lease, if known, or the leasee's incremental borrow rate. I'm sorry, you're going to hear me do that all throughout this, but I wanted to get this done. So how I've done this in the past is what I've done is I've looked at the lease and I go and I determine what is going to be my fair market value for that equipment. So I come up with the fair market value, and then I look at how much the payments. So I've got my fair market value, then I add up all my payments that are to be made over the life of the lease and subtract the fair market value. And then whatever's left over, of course, is going to be our interest. And then I make a determination on what that interest rate is based on the amount of interest that we're going to be paying over the life of the loan. And that's how I've created an amortization schedule similar to a mortgage or a note payable. Okay, lease payments are comprised of two amounts: interest and payment of principal. In addition, lease obligation, an intangible asset, is recognized for the present value payments plus any down payment made at the inception of the lease. Oftentimes, these leases have a buyout amount. Usually, it's a very small dollar amount. Okay, so you get your present value of payments, other financing sources, and cash. Because the general fund records events using the current financial resource measurement focus and does not recognize capital assets or long-term debt, the lease asset and lease liability will not appear in the general fund balance sheet. However, they do appear in the government-wide statement of net position. So worksheet entries similar to those in chapter 8 are necessary to convert capital expenditures to lease asset and lease proceeds to lease liability. Capital leases, accrual-based statements. Over time, the leased assets value in the government-wide statement is going to decrease due to depreciation, but we're not supposed to be doing depreciation. Over time, the liability is decreased by the amount of the principal retired through each lease payment. Recording the capital lease. You can see we debit our lease asset, credit the obligation under capital lease, and cash if we used any cash to purchase or to enter into this lease contract. Debt service funds and lease payments may be used to record the lease payments. Both the payment of principal and payment of interest result in an expenditure. The journal entry should keep the amounts separate because only the principal portion reduces the net liability on the government-wide statement of net position. Okay, here we go. Compensated absences. Whoops, I went way too far there, didn't I? Okay. If you've had financial accounting with me, you'll remember the time when I sat and I argued with somebody and I won in reference to vacation leave. It all depends on if the benefit is vested. If you get to take it with you, you need to record it. So government recognize the obligation over time or wait until the leave commences. Recognize when leave commences, jury duty, military service, parental leave. It's not recognized as a liability until the leave commences. Holiday leave is recognized whenever the holiday leave happens. Any vested benefit needs to be recorded as it's accrued. So that's going to be your vacation, maybe your sick leave if that's a vested benefit. You get to take it with you. Governmental funds, however, recognize expenditures only to the compensated absent payment comes due each period. So you got to make a guesstimate of how much of that is current and how much of it is long-term. And so the current will be recognized in the government funds and the entirety will be recognized in the government-wide. Pension funds. Hopefully, most of the governments are moving towards a, there's two types of pensions. There's a defined benefit and then there's your defined, for life of me, I can't remember right now. It's because I'm sick, but it's your more 401k type, your 401k type pension plans. Defined contribution. There we go. This is what happens when you get sick. Your brain kind of goes on vacation too. Okay, so your defined benefit is your plans like your military, where you put in so much service, and then at the end of the service, you get paid a retirement until you die. I've seen your old school employers with your boomer generation. Those employers are few and far between nowadays. Some governments still offer it like that. However, most businesses, most governments are moving towards the defined contribution, which is the employee withholds a certain percentage and the employer matches it up to a certain percentage. Okay. Plan reporting applies only to governments administering pensions. So Detroit would be one such government. Stationary statement of fiduciary net position reports the excess of currently available resources. Statement does not report a liability for amounts expected to be paid to current employees when they retire in the future. Employer reporting applies whether a government manages its own plan or participates in a plan administered by another government. AWC, City of Yuma, County, and I believe the school districts. Western WACOG, Western Arizona Council of Governments. They all participate in Arizona State Retirement System, which is a really great retirement system because it behaves like a defined contribution at the beginning, but it pays out like a defined benefit in the end. So Employer, central issues of employer reporting are the measurement and presentation of the net pension liability and statements. For us, we don't have to report any of that because it's managed through another entity. And so all we have to do is, like I said, there's a certain percentage the employee must pay into, and it is matched by the employer. And then the entire plan is managed by this entity, and then at the end of it, we all get paid a certain percentage of our wages. I think it's like a 5-year average. And a certain percentage of that when we retire. Total pension liability, the actuary. Okay, so you have to have an actuary. Present value of projected pension benefits that are attributable to years of services already performed. The fiduciary net position of the pension trust funds is the excess of these accumulated resources over benefits currently payable to retired employees. Net pension liability is the total pension minus fiduciary net position. Okay, so financial statements prepared using the economic resources focus and accrual basis accounting must report a liability equal to the net position pension liability for proprietary and government wide. Okay, let's keep this going. Pension expenditures for government type funds are equal to the amount paid to the pension fund for current year service. This is why it's so much easier just to do a defined contribution. Pension expense for proprietary funds and government wide every year, 3 items affect both the net pension liability, current period service costs, interest of the total pension liability, and the projected level of earnings on plan investments. Additional expenses recognized for changes in the benefit terms. And again, these are all taking into consideration a defined benefit plan, not a defined contribution. Pension discount rate. So pensions are being fully funded, and the appropriate discount rate is the long-term expected rate of return on pension plan investments. Again, this is where you're going to need your actuaries. To the extent these conditions are not met, government's required to use a discount rate based on municipal bond yields. This is more advanced. This is when you're going to need to get in there and you're going to need to start using net present value. And you can use the net present value compounded at $1 or net present value of an annuity, whatever that may be. And that's when the actuary has to say, well, it's based on this, the present value of this is worth this amount. And then you got to project out and see at what certain percent interest rate, how much you're going to make over time, which I really think is interesting because I read strange things on the internet. There was an article about the man who just won Britain's Got Talent or America's Got Talent, something like, no, it was America's Got Talent. I guess he was like a janitor in some school in Indiana. And they talked about, well, he didn't really get $1 million. He could have chose to take the net present value of the $1 million right now, or he could receive an annuity that will pay out over the next 25 years. It just depends on what they wanted to do. And so the article was talking about how it really wasn't $1 million. And so very similar to this, very similar to the lottery. Like if you win the lottery and let's say you win $10 billion, they're not going to give you $10 billion. They're going to make the assumption that, okay, what is the present value of the $10 million right now? And they're going to bring it all the way back and make the assumption that they're going to pay you over time. And what's the net present value of that? And that's what you're actually going to get paid. Other post-employee benefits. This is what I need. Though I have healthcare, disability, long-term, nursing home care, and life insurance. Reporting levels. Like pensions, there are 2 levels of reporting for the plan: fiduciary activity and employer reporting. Unlike pensions, however, many governments operate on a pay-as-you-go. And so there's no assets that are really set up for that. The accounting for OPEB, pay as you go, is very similar to that described for pensions. Financial statements prepared using the economic resources measurement focus and accrual basis of accounting must report a liability equal to the net OPEB liability. Like pensions, the net liability is the actuary computed present value of projected benefits payments less the assets currently available in the plan to meet those obligations. For many governments, there are no assets currently available, and the net liability will equal the total projected OPEB liability. Error correction. We always make errors. Now we just fix them. So you just go in there and you just have to go in and supply your journal entry and with all your proof about what happened and whatnot. Errors happen, and all we have to do is just fix them. Accounting changes, change in estimates, that can happen too as well. You're just going to have to really back up why you're making this journal entry and what's happening. Okay. Change in accounting principle. Change in accounting principle when a government changes from one GAAP to another GAAP. Changing the accounting method is not generally accepted as a correction of error, not a change in principle. Changes in accounting principle are reported by restating the financial statements of all periods presented in the financial report. Ugh, this sounds awful. Cumulative effect of the change for periods prior to the earliest year appearing in the comparative statements is reported as a restatement of beginning residual equity of the earliest. Okay, then we keep looking at this because of the disaggregated nature of governmental reporting. Governments are more likely than private sector businesses to experience change in accounting entity. Now, what's really interesting is I'm going to be going to, I believe it's in November, and unfortunately, I'm not going to be able to bring a whole lot back into the classroom, but I'm going to an academic webinar where GASB is going to tell us about some of the changes that they are expecting for governmental entities. Change in accounting entity occurs when identifiable government operations move between fund bases, financial statements between columns in any given. And this really doesn't happen that often. A change in entity can occur by moving a governmental service from a non-governmental fund by creating an enterprise fund. When a fund moves between major or non-major status, addition or removal of a component unit due to a change in its governance, by changing the presentation of a component unit between blended and discrete presentation. GASB requires governments to reflect changes in accounting entity in the current period as if the change occurred on the first day of the fiscal year. If the government presents comparative financial statements, the financial statements are not restated. The GASB rationale for this treatment is that a change in entity results from a change in circumstances that they didn't really have any control over. You are going to have some required supplementary information, and other supplementary information may present up to 10 years of information. How should the accounting changes be reported for current prior years? Generally, treatment of accounting changes affecting RSI and SI parallels that of financial statements. Changes in accounting entity and changes in accounting estimates are reflected in RSI and SI information for the year of the change and the information for prior year, so you need to update it. For changes in accounting principle, GASB requires to restate financial information contained in RSI or SI for periods in which the government presents comparative financial statements, but not for periods prior to those appearing in the financial statements. So if you only go back 3 years, you only go back 3 years. If you only go back 2 years, you only go back 2 years. Error correction, again, financial, that one's going to be reported in the current period. And that is the end of the main content for chapter 9. So there we go. And hopefully I will be sounding a whole lot better and not coughing so much next week.